Well, certainly at some point the U.S. is going to experience another bear market. The good news is we're not seeing the typical signs that you see right ahead of a bear market. But there are a couple of things that investors want to keep in mind. The first and most important of which is that given where we are in the cycle, and given the fact that valuations have stretched quite a bit over the past 5 years, you have to have more modest expectations about the next 5 years. It's very unlikely that we're going to see consistent years of double-digit returns the way we have for most of the past 5 years. In terms of what to be doing in your portfolio, I think there are a couple of places you want to watch. The most concerning would be those stocks that are generally viewed as bond market proxies. Stocks that pay high dividends, such as utility companies or consumer staple companies. And the reason is people have been flocking to these names for the last 5 years in order to get some income. And as a result, they're expensive. If we do start to see the Fed raise rates, that's likely to bring those valuations down somewhat. So instead, we'd be looking to add allocations, one outside the United States, but also to those parts of the market that don't look as expensive and are likely to prove more resilient in the face of a Fed tightening cycle. And examples of that would include technology, healthcare, and while it's not popular right now, energy as well.